What's going on, guys? Welcome back to the channel. Welcome back to another video. A lot of you guys have asked me, hey Ron, how do you invest in the stock market? Where do you invest? And I just wanted to let you guys know that I usually invest through a few different methods. I'm not going to go into all the different methods on this video, but for certain, I'm investing in index funds, ETFs, and mutual funds. Some of the platforms that I use many different ones for different reasons. M1 Finance, Fidelity, E-Trade, and what's another one that I use regularly? I can't think of the other one. Anyway, so that should give you guys a good start. I'll leave some helpful links for you guys in the comment section or in the description of this video down below. But today, I wanted to talk to you guys about the Federal Reserve and the direction of the stock market. Now, the Federal Reserve, Fed Chair Jerome Powell, he's released some pretty interesting remarks. And this is kind of like a drama with the economy, the oncoming recession, because we technically haven't had a recession yet. Here we are in almost the halftime of 2023, and we really haven't had a recession yet. So where do we go from here? How do we build wealth? How do we grow our brokerage accounts? How do we increase our net worth from here? Well, you got to look at what's happening in the stock market. So if we look at the S&P 500 right now, we're sitting at what, 4,000. Here I am about to try to adjust the screen, only to find out that my Mac is not a touchscreen laptop. But anyway, I don't know why Apple does that with their Macs. Like, why aren't they touchscreen? I mean, the technology is there. They do it with the iPad. Anyway, I digress. So if you look here, S&P 500 is sitting at 4,426 points. Now, if we look at the year to date, the S&P 500 year to date is the S&P 500 year to date is up roughly 600 points. Now, why is the stock market up right now? Well, you have to understand the market dynamics and the power that the Fed has, right? So first of all, whenever the stock market goes up or the stock market goes down, you have to understand that there's always transactions that are taking place, right? So you have investors that are banking on the stock market being worth more in the future. And so those investors are basically bullish investors. They may have 401k accounts. They may be hedge fund managers. They may be, just regular people working a 9 to 5 that, make regular contributions, or maybe they're swing traders expecting the market to go higher in the future. There's a number of different investment strategies out there, but long and short of it is that people who are buying into the market and they're buying into the stock market going long, they're betting on the economy being in a better shape in the future, or maybe not necessarily the economy, but they think that the stock market is going to be worth more in the future. Why else would you buy or invest in something unless you thought it would be worth more in the future, right? So you have bullish investors banking on the stock market being worth more in the future. And this could be for a number of different factors. The Fed indicated that, they're not going to raise interest rates a couple of weeks ago during the last Fed meeting. So if the Fed is not going to raise interest rates as of June, then that is a bullish sign for anyone who is expecting or hoping that the Fed stops raising interest rates. If you're a fan of the Fed reducing interest rates, then this is also a very good sign, because if the Fed has been raising interest rates for like the last 10 to 14 different sessions, I don't remember how many sessions that they've had since March of 2022, then we know for a fact that if they've had this pattern of raising interest rates during every single meeting, and then they suddenly stopped, well, that's a change in pattern. If we have a change in pattern, then maybe eventually we see a change in course. Now, if you had invested in the stock market, particularly since we're talking about the S&P 500 since, let's just say since January, let me refresh this chart. If you were invested in the stock market from January 1st, 2023, the stock market was at, or the S&P 500 was at 3861. Today, it's at 42 27. So let me just get my calculator out. We got 38 divided by 40, 44.27. You would have been up 15% on your money in less than 6 months. And so this is the power of the stock market. And a lot of people were worried about the stock market crashing because we did see a significant pullback in 2022. But if you guys remember, I always remind you that whenever you have a stock market pullback, that is kind of like a rubber band typically. If you look at the long-term trajectory of the S&P 500, the stock market generally goes up. And if you look at any 15-year time frame, I would say that if you look at any 15-year time frame without fail, the stock market has been positive. So what that means to me is that if you have a long-term perspective and a long-term horizon expectation of the stock market performance, then you should do well in the stock market, assuming you're investing in solid investments. Like, if I didn't know anything about investing in the stock market, very simply put, I would just invest in index funds that track the S&P 500. You're looking at your iShares, S&P 500 tracking indexes and ETFs. You're looking at your Vanguard, your VOO, ticker symbol ETFs, which of course can be invested in any number of investment platforms. Robinhood, M1 Finance, Charles Schwab, you name it. Now, why does the stock market go down? Well, the stock market goes down because whenever there's a trade taking place, whenever someone's buying a stock, someone else is selling that stock. Whenever someone's selling a stock, someone else is buying the stock. You cannot sell something without someone else buying it. Imagine trying to sell your car. Selling your car is like selling a stock. If you think the stock market is going to crash and you sell your stocks, think about it. Somebody disagrees with you because they're buying it. So as you're selling your stock, you're in fear of whatever the future, you're in fear of whatever you think the future might hold. If you're selling your stock, think about it. If you're able to sell it, that means somebody was waiting to buy it. Same thing goes with your car. If you decide to sell your car, the only way to sell your car is if someone else is buying it. So the way I see the stock market is whenever the stock market is heading down, there's more sellers in the market than there are buyers, and then the selling pressure gets pushed on the market and it drives equities and asset prices down. Whenever the stock market's going up, it's doing the exact opposite. Basically, there's more buyers or there's more demand for equities, and it's driving the prices up. Very similar to what we saw in real estate. When the Fed lowered interest rates for, short term, when the Fed lowered the federal funds rate, this had a direct impact on short-term lending, short-term interest rates, the 30-year treasury, and ultimately affected the mortgage rates. And when those mortgage rates began going below 4%, 3%, people saw that cheap money and they said, hey, I can buy way more house with this low interest rate than I could when it was at 5%. When you had 5 and 6, well, here we are today. You're at 7% interest rates, right? If you're at 7% interest rates, let's just say your bank approves you for $500,000 house. But if those interest rates were to go back down to say 3%, you may be able to afford a $600,000, maybe $650,000 house for the same mortgage payment that you would have been able to afford when interest rates were at 7%. So what did that do? That cheap money drove up the demand for homes. And so that's part of why home prices went up. Very similar to the stock market. When the demand went high, when people believe that something's going to be worth more in the future, the desire to invest in that particular asset goes up. And is similar in the opposite direction. When people believe that the asset's going to go down in value, people want to sell. Real estate's a little bit different though. Simple fact of the matter is that with real estate, most people who buy real estate live in their homes. So even if people thought real estate prices were going to go down, they're not as likely to sell the asset because they're using the asset. And so you have to live somewhere. So if you sold your house, you're either going to buy a new house or you're going to rent. So it's a little different compared to the stock market, because if you think the stock market is going to go down, you're not using the stock. You're only holding the asset based on your expectation of future value. So if you think the stock market is going down and you want to sell out, you probably just sell out. Not to mention, it's super simple. Open up your app on your phone, your M1 Finance app, your E-Trade Fidelity app, and you just click sell. And now now you're back in cash. And then you use that cash however you want, right? And then once the market sentiment changes, if you think the stock market is going to go back up, then you go ahead and jump back in. But this is basically what's happening, folks. So I think we continue to watch what the Fed's doing. We continue to watch the markets. Keep some dry powder ready to go. By dry powder, I'm talking about cash. And continue to invest in quality stocks. That's what I'm doing. Keep your emergency fund strong. And let's get ready for the next movement. I think that we're going to continue to see this wealth transfer continue to unfold. And I think smart money, if you're following this channel, smart money is going to figure out where these different opportunities are, and you're going to capitalize. So drop me some comments, you guys. Let me know what you guys thought about today's discussion. Like, comment, subscribe to the channel, and I'll catch you guys on the next one.